You buy a $1,000 IOU, paying 4% interest. 6 months later, interest rates jump to 6%. Your IOU is now worth $850. Nothing broke. You just watched finance's weirdest optical illusion. Here's what actually happened. Bonds are loans. You hand cash to a government or company. They hand you a certificate promising fixed interest payments plus your principal back at a set date. Sounds static, right? It's not. Between the day you buy and the day it matures, that bond trades on a secondary market where its price bounces around daily, usually moving opposite to prevailing interest rates. This inverse dance confuses everyone at first because it runs backward from normal asset logic. Stocks rise when things look good. Bonds fall when rates rise, even though rising rates often signal economic strength. The reason lives in how buyers value future cash flows today. Let's define terms fast. A bond's yield is the annual return it delivers, expressed as a percentage. A $1,000 bond, paying $40 yearly, has a 4% yield. Price is what someone will pay you for that bond right now on the open market, which may be above, below, or exactly at face value. Duration measures how sensitive a bond's price is to interest rate changes, roughly estimating how many years of payments you'd need to recoup the bond's cost. Longer duration means bigger price swings when rates move. Think of duration as a bond's shock absorber. Low duration, gentle bumps. High duration, you feel every pothole. Here's the mechanical seesaw. You buy a 10-year Treasury bond for $1,000 at 3% yield. You're locked into $30 annually for a decade. 1 year later, the Federal Reserve hikes rates and new 10-year Treasuries now yield 5%. Fresh buyers have a choice. Your old 3% bond or a shiny new 5% bond for the same $1,000. Rational actors pick 5%. So if you want to sell your bond early, you have to drop the price. Maybe someone pays $850 for your bond. They still get $30 yearly, but because they paid less upfront, their effective yield climbs above 3%, closer to that market rate of 5%. The bond's coupon payment never changed, but the market price fell to make the math work. Price down, yield up. That's one direction of the seesaw. Flip it. Imagine rates drop from 5% to 3% after you buy. Your 5% bond is now a rock star. New bonds only pay 3%, so buyers will pay a premium for yours, maybe $1,150. You could sell at a profit. The buyer accepts a lower effective yield because they're paying above face value, but they still come out ahead of buying a fresh 3% bond. Price up, yield down. The seesaw tips the other way. Why does this happen? Opportunity cost. Money has options. If you can earn 5% risk-free on a new bond, you won't pay full price for a 3% bond unless the seller discounts it enough to match that 5% return. The bond itself doesn't know rates changed. It keeps paying its fixed coupon. But the market reprices it instantly, adjusting for what else your dollars could be doing. This repricing accelerates with time. A bond maturing in 1 year barely budges when rates shift because you're getting your principal back soon anyway. A 30-year bond, huge swings. You're stuck with below-market payments for 3 decades unless someone compensates you via a lower purchase price. That's duration at work. A 30-year bond might have a duration of 18, meaning a 1% rate hike could drop its price roughly 18%. A 2-year bond with duration of 1.9 only falls about 1.9%. Same rate move, wildly different impact. Example math to nail this down. You hold a $1,000 bond, 4% coupon, 10 years to maturity. Duration is approximately 8. Interest rates jump 1%. Price falls roughly 8%, so your bond is now worth about $920. You didn't lose $80 unless you sell. If you hold to maturity, you still get $1,000 back, plus all those $40 annual payments. But if you check your bond fund balance or brokerage account, you'll see $920 today. That mark-to-market value shifts constantly. Conversely, if rates dropped 1%, your bond's price would rise about 8% to $1,080. You could sell at a profit, or just enjoy watching your account balance tick up. The actual cash flows you receive, $40 yearly, never change. Only the market's valuation of those future payments moves. People mess up this concept in predictable ways. First misconception: my bond matured in 10 years, so I can't lose money. True if you hold to maturity. False if you sell early or own a bond fund that never matures. Bond funds constantly buy and sell, so their price reflects current rate environments. You can absolutely see negative returns in a bond fund during rate hike cycles. Second misconception: higher yields are bad for bondholders. New buyers love higher yields, they lock in better returns. Existing bondholders holding lower-yielding bonds see price declines, but if they're reinvesting coupon payments, they now buy new bonds at those higher yields. Over time, that can offset price drops. Third misconception: this only matters for individual bonds. Nope. Any bond fund, treasury ETF, or even certain savings bonds fluctuate with rate changes. The mark-to-market loss is real even if you never sell. Where does the simple story crack? Credit risk complicates things. Corporate bonds don't just move with interest rates, they also react to the company's financial health. If a firm wobbles, its bond price can plummet even if rates stay flat. Inflation expectations twist the seesaw further. Real yields matter more than nominal. If inflation roars and a 4% bond barely keeps pace, buyers demand higher yields, tanking prices beyond what base rate moves would predict. Liquidity adds friction. Thinly traded bonds can have wide bid-ask spreads, meaning the market price is more theoretical than actionable. And callable bonds let issuers redeem early if rates drop, capping your upside. You won't see the full price appreciation, because the issuer yanks the bond back at face value just when it's worth more. The seesaw also behaves oddly at extreme duration levels. Zero coupon bonds, which pay no interest, only face value at maturity, have duration equal to their maturity. A 20-year zero has duration of 20, so a 1% rate move swings price by roughly 20%. They're hypersensitive. Meanwhile, floating rate bonds reset their coupon periodically to match current rates, so their price barely moves. Duration near zero. They sidestep the seesaw almost entirely. And at the far end, perpetual bonds with no maturity date act like extremely long-duration instruments, whipsawing violently with tiny rate shifts. So here's what bonds actually are: tradable IOUs with fixed payment schedules that the market constantly reprices based on alternative uses for money. When rates rise, existing bonds paying below-market coupons lose value because buyers can get better deals elsewhere. When rates fall, existing bonds paying above-market coupons gain value because they're suddenly scarce. Duration quantifies how much that repricing hurts or helps. If you hold to maturity, the seesaw is just noise. You get your promised payments regardless. If you sell early or own a fund, the seesaw is your daily reality. That inverse price-yield relationship isn't a bug. It's bonds working exactly as designed, adjusting in real time so every bond's effective yield roughly matches the current cost of borrowing. The IOU's face stays the same. The market's opinion of what it's worth, that swings every single day.